you've got 2 million saved and you're wondering, should we do Roth conversions? If you're approaching retirement and that's the burning question keeping you up at night, this video is for you. Now, I want to be as educational as possible in this video. I'm going to use a real world scenario because I think that's how it's easiest to put the pieces together to know should you or should you not be thinking about this decision. Now, this is not personal financial tax or investment advice, it's just educational. But if you've ever wondered, what about Social Security timing? What about my spending level? What about my age and life expectancy? I want to do qualified charitable distributions. How do these all factor in together to think about Roth conversions? There's also Medicare and IRMAA planning. There's premium ACA charges for healthcare. All of these things are rolling around in your head thinking, how do I know if I'm going to do these and how do they impact my overall plan? That's what today's for. Hope you enjoy it. If you're new to the channel, my name is Forrest Dutton. I'm the owner of Brightworks Financial Planning. I'm a certified financial planner and I love doing these videos to help you retire with confidence. So without further ado, let's get into it. Okay, let's jump into today's case study. So we have a couple. They are married filing jointly, and they have $2 million saved. They are 60 and turning 61 in 2026. They want to retire, and their question is, should we do Roth conversions? Let me walk you through the facts of this case. So first of all, inflation is going to be assumed to be 3%. That's going to apply to things like expenses that they have in retirement, any income that they earn. I've also put a 2.5% inflation on Social Security. And if we think about what is the asset mix that this couple has, meaning how have they saved over their lifetime to get to this $2 million? Now, when I say $2 million, you'll see in a second that they actually have a little bit more. $2 million is the tax-deferred money. Now, for most people, that's going to be in the form of a 401k or an employer retirement plan or an IRA. So we're assuming that each spouse has $1 million in tax-deferred assets. And then I'm also assuming that they have a taxable brokerage account, because anyone who wants to retire before 65, this is a very, very powerful account to have. So I'm assuming they have this and they're turning 61 this year as a reminder. In that taxable brokerage, they have $300,000 and about $150,000 of that is growth. That will factor into taxes when they early on start drawing from this account because they want to take advantage of this 0% capital gains bracket. So what you're going to see here is I've factored in that there's a 5% rate of return on their brokerage account. There is a 6% rate of return on their tax-deferred account. And I've also assumed that they have no Roth money as the start of this plan. Now, in terms of Social Security, we're going to assume that they've decided to take Social Security at age 70, because the whole point here is we're going to assume that they are looking at a scenario where they don't convert or whether they do convert. So even if they don't convert, it would be much more advantageous for them to delay Social Security so that, again, they can be spending their taxable brokerage money and take advantage of that capital gains bracket. So I'm assuming in both cases that Social Security is drawn at age 70. I'm assuming both spouses have a pretty strong working record so that at age 70 they both can draw $30,000 in Social Security. Now, I've added another thing in this plan, which again may or may not apply to you, but I think it's fairly safe to assume that it does apply to some retirees. So this particular couple has a deferred annuity. So at age 70, they're going to get $1,500 a month for life, and that has a 100% survivorship. So if we're thinking about our income sources, there's one more thing I put in here is sometimes when couples retire early, both spouses don't retire at the same time. So what I've done here is I have one working part-time for a number of years, and that's going to end at age 65. So that's what's in for the inputs, and they're going to make $40,000 until age 65. Now, the spending for this couple is they want to live on $80,000 a year. Now, based off what I just told you, the first few years is going to be a combination of income from wages and then income that needs to come from portfolio. But the $80,000 number is a number they've worked out and they're comfortable with. They have paid off debts and they want to live off $80,000. So those are the inputs. And so now I want to talk you through, again, we're going to calculate Medicare Part B and Part D as part of this exercise. And then what we're going to look at is, in addition to that, a series of Roth conversions to look at, is this maybe a wise decision in this fictitious case? Again, not personal advice. And when I do this for clients, I always get the tax preparer involved so that we can all be on the same page to make sure we're making the right decision. But the point of this video, again, is education. It's meant to help you see what these factors are that I'm projecting, and see which ones apply to you and which ones you may want to think more about. So let's go into it first. So what I've done here is I want to start with the distribution so you can see what's actually happening. So down here, what you're going to see is what's called a base case, and down here we have a Roth case. So let's start with base case so you can understand what would this client couple be doing if we didn't do any Roth conversions. Well, what you can see is this teal bar represents taxable assets. So early on, to get to that 80,000 number that they need, remember there's wages happening for the first 4 years. So that number you see, so just highlighting over age 64, is saying we need to take 45,000 out of that taxable brokerage because we already have 40,000 in earnings. And then what you see is when you get to 65, that's the last year. Again, there's no working years, so they work for 4 years. At age 65, they're no longer working, so they have to take those assets from a taxable. And then when we get to 66, that's when they run out. And then when you see purple, that means we're beginning to draw from tax-deferred assets. And the reason I start here is because, remember, there's a very favorable tax case in the very beginning 6 years here. 1, 2, 3, 4, 5, 6. Basically, their taxable income is going to be very low. Like, this is without conversions. When we get to 67, all of a sudden, okay, we need some money. We have no more part-time income, and we're out of our taxable assets. So they've totally been depleted. So for 3 years, there's a bit of a heavier draw, but if you look at what would happen to that $2 million from age 61 to age 67, it would have grown. So this still doesn't represent a high withdrawal rate. So we have 3 years where we're taking, I would consider, maybe a normal withdrawal rate. Then what happens is between 70 and 75, the client's tax-deferred assets don't require much distribution because, remember, Social Security kicks in for both spouses. So we've got essentially 30 plus 30 for Social Security, that's 60, plus another 18, so we've got 78,000. And so that 80,000 in tomorrow's dollars is more. So basically, to make 80,000 in today's dollars, we would need 22,000 in tax-deferred distributions. Now, what that means is, by the time we get to 75, they're projecting these RMDs. So light blue is one spouse, green is the other spouse. So that's the total required minimum distributions. Now, what does that actually look like when we map it on a tax bracket? So what you can see here is, I'll hover over this, you're going to see the different brackets. And basically what this is showing you exactly what I said. So from age 61 on all the way to 65, we basically have no income. It's not till we hit 66 and 7 that we actually start having taxable income, because remember, there's the 0% tax capital gains bracket. That's what we're actually utilizing, and then obviously there's standard deductions. It's assuming it inflates, so we have very little tax at all until age 67. Now, in the Roth case, what we're going to do is we're going to do conversions all the way from the current year, which is when they turn 61, all the way to 69. And these brackets you're seeing is what we're actually doing here is, for this Roth conversion case, we've decided to fill up the 12% bracket. So if you see this green line all the way across, that represents the 22% bracket. So notice the very light bar is if we did nothing. That's the base case. I'll hover over it. And basically the base case is showing that once we hit RMD age, we're going to jump up over the 22% bracket, and we never leave it. So the yellow would represent 24, so you can see that light bar never goes up to 24. But it does mean for a good portion of their later retirement, they're going to be in the 22% bracket. So what we've done here is I've just decided to fill up the 12 before we get to Social Security, and that's what this represents, so that we pretty much stay in the 12 in all of retirement. It's only the last few years where you just sneak over it. So that's what you're seeing, okay? So the question then becomes, was that a good decision? Should we have done that? And the best way to answer that is through a combination of factors, right? So I have in here that the life expectancy of this couple is 90. I also have that there's a discount rate that I've applied to the difference in lifetime tax. So in most cases when you do conversions like this, if it makes anywhere close to being sensible, you're going to see a lower lifetime tax. But that doesn't tell the whole story. You have to figure out what is that worth in today's dollars. That's called present value analysis. This was what a corporation would do when they put in money up front to a project and they look at the cash flows afterwards. So we're essentially saying, how much did we pay in taxes over these years up until age 70, and we're discounting that based off some rate. Now there is some debate about what rate we should use. I'm using 5 because what we would be using to pay those taxes is the taxable brokerage account, which I have modeled at 5%. So you could change this, you could debate it, but you've got to use something I think that has some basis in reality. So that's why I've used 5% as a discount rate. And if we use that, what we see here is that the present value is negative 1,284. So translation, this is pretty much a wash. So if a present value was 0, it's basically literally there's no difference between the two paths. That's at this level. Now the point of this video is again not to say Roth conversions are that simple. They are absolutely not. I've done multiple videos on them that talk about different factors. But I just want to show you how I would kind of be walking through how the different variables might change your decision. So let's just start playing with a few variables so I can tell you through the ones I think are most important. So one obviously is life expectancy. The reason this present value is negative is because we are discounting it over the lifetime of this couple. So if I change, and I make no other change besides, let's go up here to life expectancy, and let's just make this longer, 95. Now this is going to take a minute because I'm going to have to rerun the analysis. But while this is rerunning, I just want to take a second to think about and remind you that in reality, none of us know our life expectancy. So this is something you may want to do some work on the front end to actually determine, to figure out what is your life expectancy. That could be family history, that could be looking at your current health conditions. There are some different calculators and actuarial associations that help you figure out your life expectancy, but in reality no one really knows. So as we're doing this analysis, this is something that you want to think about, and this could go on both sides. So this is you and your spouse, because what I'm going to show you here is just moving this 5 years is going to change the results of our projections, which shouldn't be surprising to you, but I think I want you to see the degree to which it changes it under certain circumstances. Now the other thing, so notice just moving this out 5 years drastically changed our results. Now we have a pretty solid present value here. So the present value here being 29,737, to me that's a much more favorable outcome. Now we don't need to model this, but if I were to take this backwards, right? So if we go back to 85 and 80, you're going to see that present value go even more negative. So I just wanted you to see how that interacts. I'm going to change it back, and while I'm changing it back, I also want to talk through the next thing that I think you should really think about. So the next thing that you should really think about when it comes to doing the Roth conversion analysis is down here. There's a section that, in addition to Roth conversions, if you are charitably inclined at all, you can actually make qualified charitable distributions as part of your overall retirement plan. Now, you can't make these until you're 70 and a half. So what I'm going to do here is I'm just going to put a modest amount of qualified charitable distributions. So let me just explain really quickly, why would that matter? It matters because when you take those, they come directly from your tax-deferred asset, whether that's from your IRA. So in that case, what happens is that money is not taxable to you. So the other thing that could actually help with is, again, the whole concept of having larger required minimum distributions because you don't need the money later in retirement. You could mitigate that through qualified charitable distributions. So because of that, the value of your tax-deferred money will be much lower in those later years, because you basically, for most people watching this video, if you're born in 1960 and after, you're going to have to take out those distributions at 75. So you essentially have a 5-year window to make these qualified charitable distributions. So let's just do something modest, okay? So we're going to start these in the age they're 70 and a half. Let's just do $8,000 a year. Since we used $80,000, I'm just going to say 10%. Whoop, a little too many zeros. Okay, so let's apply that and let's see how that actually impacts things. So remember, just to be clear, we're not changing anything. We're still going to fill up the 12% bracket. We're still going to live on $80,000, but when we're 71, I'm taking this out of one client's IRA, but it really shouldn't matter. This is a household value, so I'm going to say that $8,000 is what's coming out per year in the way of qualified charitable distributions. So should be just a couple other seconds here, and this will be done, and then we will look at this together. So remember, we had a slightly negative present value at $1,284. We haven't played with any other variables. So let's see what actually happens here when we do qualified charitable distributions. And this, again, is another principle. So again, thinking about qualified charitable distributions, the other thing you need to really think about is these things will layer on top of each other. So you need to make sure you model your specific scenario to know exactly how this will play into it. So here we go. There's our results. So now we are actually more negative on present value, and that makes sense, right? So the point I'm showing you here is I want you to see which variable will send this into the more favorable or less favorable, because when it comes to Roth conversions, sometimes directionality is what matters, because in reality, this is just a computer. It's just modeling things that may or may not be perfectly accurate. But if you can see something going in the right directionality, that would be really, really favorable. So for example, if you were someone that said, man, I think my life expectancy is actually less than average, or my wife's or husband's might be less than average, and also we're really charitable, we want to give a lot of money. Well, you can see how layering these on top of each other would give you a very negative present value directionality, right? Because I just modeled two things on top of each other that are going to compound. So you would see that negative bracket go even further, right? So these are two things that I think are pretty important. And what I'm showing you here is how do you put these together. So let's just leave the QCD. I took the age back to 90, okay? So we're just gonna leave that. But what if we just change one variable, which is spending? So I would argue that a couple that has $2 million and is gonna have Social Security and annuity later, $80,000 is a little bit low. You could probably spend more than that. Now again, that's not advice. I just think it's very reasonable from a practicality standpoint to consider saving a little bit more. So let's just, or sorry, not saving, spending, excuse me. So if we're spending a little bit more, let's see how that variable impacts our decision to do Roth conversions. So I hope you're beginning to see that these things are not, they don't exist in isolation. And when it comes to Roth conversion analysis, you need all of these together, because if you're just looking at one, you're not getting the whole picture. So just starting from scratch, remember we started from a lifetime tax number, but that doesn't really give us the true value of making this decision. So then we have to layer on present value analysis. Now, even then, we have to take all the factors into consideration to figure out how that actually impacts the present value. So hopefully you're seeing how the puzzle is put together. You start very big picture, and then you get smaller and smaller, and then really moving alongside all these things are your values. I'm just talking through some numbers analysis right now, but in reality, sometimes people want flexibility. Sometimes they want legacy, and they want to just know that they're giving their kids tax-free money. That doesn't show up on the spreadsheet, right? Or protecting a spouse because one might be gone before the other. That doesn't show up on the spreadsheet. So I just want to bring that up. All right, notice spending more. I'm gonna redo the analysis here for the 12% bracket. But all we changed here, remember, this is still age 90. This is still giving some charitable money after 70 and a half until your life expectancy. And the only thing we've changed is how much money do we want to spend. So before we did 80,000, but I've upped this to 100,000. It's the only change that I've made. And I'm still going to show you what it looks like to fill up that 12% bracket. And I'm wanting to show you, again, directionality and which way this is going to sway us in terms of what is the present value looking like for this decision. So hopefully the spinning wheel of doom will be gone soon, and we will get the present value on this. Now, these aren't the only factors when it comes to Roth conversions. I want to be really clear about that in this video. There's always more things that you can consider. There are always nuances when it comes to rates of return, how portfolios are invested, and there's no way to model every little thing. But the point of this video is to show you again, okay, so here we go. So in terms of present value, we went further negative. So again, you can see why, right? Because even it's a little bit harder to see, but notice the light bar represents doing nothing. So even doing nothing for not until you actually hit RMD age do you barely start to creep over that 22% bracket, and how far you're into it, you can see the bars are not very high, right? So this makes sense to me. If you spend more earlier, it just means that you're not going to save as much by doing those Roth conversions, and it also would make no sense at all to go even higher. If you go to the 24%, you're going to see all these be heavily negative. So I think that's enough for this video. I just want to have one more thought here, that depending on what you're doing, IRMAA could be a consideration, but at this spending level, whether you do nothing or whether you do Roth conversions at this level, you're never going to hit that tier 1 of IRMAA surcharges. Just by way of education, IRMAA is basically a surcharge on your Medicare premiums that you pay every month based off of your earnings 2 years prior. So this would not come into play for this couple. It's showing it at 61, but it actually wouldn't even come into play until age 63, because you have to go 2 years back from when Medicare starts, which is age 65. But they're not making enough income, either from Roth conversions or from the other income they're drawing. So this really isn't an IRMAA case. But if you had more, you could apply these principles to any level. So just wanted to do this with 2 million to show you that this may not be as straightforward as you think, because in my opinion, there's a lot of fear in terms of the retirement education of, if you have 2 million, you have to convert or you're in trouble. I really don't think that's true, and I think you need to think this through and make sure you understand why you're making the decision you make. So that concludes today's video. Please like and subscribe. Actually, please comment. I want to know what factors you think would be more relevant to your personal case, or what do you think I missed, or what do you think that you need more education on. I'm doing these videos to help people have more confidence in making these decisions. So please leave your comments. Let me know what you think.